Okay, so I'm literally just going to wing this now and start creating a strategy from scratch. So at the moment, I have no idea whether this works or not. I'm going to be using two moving averages, the 50 moving average and the 200 moving average. They're both going to be exponential moving averages. You can get free access to all of this through TradingView. So I'm just going to sort of explain my thought process as we go through this. So yeah, let's get started. So put two moving averages on and change one of them. We'll leave as orange and leave it as the 50 EMA exponential moving average. We'll have this 50 and source will be the close. Okay. We'll have this one as a dark blue. This will be the 200. So 250 moving average, both of these are sort of not an industry standard, but like a finance background sort of standard. So with equities or anything like that, you'll see on the news, like on Bloomberg or something, you'll see on these sorts of programs, the 200 and the 50 moving average quite a lot. So whenever these two moving averages cross like this, they're either known as the golden cross or the death cross. So basically, when the 50 moves above the 200, it's known as a golden cross because you can expect price to continue moving higher. So for example, if a certain company's stock is, so at this point here, we're looking at this and they would be saying on the news, oh, the golden cross is coming, 50 moving averages getting closer to the 200 moving average, so we can expect continued rally to the upside once this cross happens. So I've just added these on here, so the 50 and the 200. Basically, these just literally do exactly what they say. So they average out the price of the previous 50 bars, and the 200 moving average averages out the price of the previous 200 bars. And then it just draws it out. So obviously, the greater you, the larger the number, the more smooth this line is going to be, and the lower the number. So if it was 1, it's the average price of 1 bar, so it's literally going to follow this chart exactly how this is. Obviously if it's 10, it's going to be tighter. So at the moment this 50 sort of evens out all of these peaks and troughs here. It just evens that out. The lower the number you go, the more noise you're going to get in your moving average, and the higher the number, the less noise. So if we go back, this is on the Euro-dollar hourly chart. If we just keep going back into the history of the chart, we'll start here. So what I'm looking for immediately, we know our bias just by having these two on. So the moment the 50 and the 200 cross, so when the 50 is above the 200, we're looking for bullish moves or buying opportunities. So that is one thing we've already got ticked off, is our sort of what we're looking for. So 50's moved above the 200, we're looking for buying opportunities. So in our strategy, what we'll have is we can only place buy orders when the 50 is above the 200. We can't sell. So when the 50 is above the 200, we can't place any selling or bearish. We're not projecting any bearish movements. We're only going to be entering long positions when the 50 is above the 200. Next reason, we want to look for reasons for entry. So we've got our what we're looking for. So we now know the 50 is above the 200, we can start looking for buying opportunities. But what's going to determine our buying opportunities? So we're not just going to buy anywhere just because the 50 is above the 200. And we're not just going to buy it because it's crossed the 200. We need to actually come up with a defined reason for entering a trade. So the first part of this, I would say, is when we touch the 50 moving average. So if we pull back in, so like here, we've the 50 moving average has crossed above the 200. Let's go as if it was present day. Price is then retraced back and it's touched the 50 EMA. That is our first thing we're going to look for. So at this point here, we're going to be thinking, okay, now we've got our sort of reason to look for an entry reason. So again, this is just a confirmation that the trend is bullish, so we can place buy orders. Here, the touch. Now we're looking for entry reasons because it's touched the 50 EMA. And then secondly, we've covered engulfing candles. That's on my website if you are a bit confused about what engulfing candles are. And then secondly, I'd be looking for an engulfing candle to place a trade. So the moment that engulfing candle closes, we're going to place a buy order, and we get that here. So ignore, obviously, we've got to see the future of the chart here. Ignore that. So at this point here, we've had the touch. We didn't get an engulfing candle here. We then get another touch, and we get an engulfing candle here. So this bullish candle, this white candle, completely engulfs the candle before it. And it also engulfs the candle before that, which makes it an even stronger sort of bullish indicator. So we've got our bullish, turn the magnet off, sorry. So we've got our bullish engulfing candle, which is our entry reason. So the moment this candle closes, we're going to enter. So this is where we're going to enter a trade. So now we've got our the direction we're looking to enter a trade in. We've got our entry point, and we've got our entry reason. We need the trade management stuff. So this is where our stop loss is going to go, where our targets are going to go, how much risk are we going to risk per trade, 1% of the account, 2% of the account, and so on and so forth. So again, I'm sort of winging this at the moment. So if we enter a buy opportunity here, now let's just base it off of this trade so we know this is going to be a profitable trade, and then we can follow it into the future and test if it's going to be consistently profitable. So let's just go, let's just keep it nice and easy. What am I going to do? Let's do 15 pips. 15 pips and 15 pips. Copy that. Right, so our entry reason is obviously at the black line here. We've got a risk to reward of 1. So we know if we've got a risk to reward of 1, we only need a plus 50% win rate. So if it's a 1-to-1 risk to reward, we only need to win 51% of the time, and we will be profitable over a long period of time. Yeah, that should make sense to everyone. I don't quite know how I can expand on that. It's pretty self-explanatory. So we need a greater than 50% win rate in order for this strategy to be profitable. We're risking 15 pips to make 15 pips. So for example, in monetary terms, we'd be risking £100 to make £100. Doesn't matter on the pips because you'd be doing it off the percentage of your account. So if you're risking 1% of your account at 15 pips, or risking 1% of your account at 150 pips, 1% of your account is 1% of your account. It doesn't matter how many pips it is. But for this example, we're going to risk 15 to make 15. And obviously in this instance here, we're going to enter the trade at the close of this bullish engulfing candle. And we're going to set our stop loss down here, minus 15 pips. And we're going to set our target here at plus 15 pips. Obviously at this point, we get a slight retracement back down here, and then price immediately hits our target of 15 pips. So that would be us out of that trade. It doesn't matter if it's gone higher, it doesn't matter if it's retraced back down, we're now out. At this point here, we have closed out of this trade. So from this point onwards, we don't care what's happened. Yeah, you can look at this and say, yeah, we would have made twice the amount of money if we'd have, yeah, what if? It doesn't matter. Stick to your strategy. There's always going to be the what if, but these opportunities will also come in the reverse, as you'll see soon, that what if we'd have taken this and left the trade running? You could also say, what if we'd have got out, we have left it on a different trade, and price would have reversed and hit your stop loss. So it's best to just come up with a strategy like this: 15 pips stop loss, 15 pip target, get out and forget about it. Don't worry about what's happening in the future or after the trade is closed. So I'll copy this across, 15 pips. So that trade would have closed out here. We've then pulled back down. We don't get an engulfing candle. Again, we've pulled back down, touched it. We don't get an engulfing candle. Technically, this could be classed as an engulfing candle. I prefer mine to be engulfing a bearish candle. However, technically, this could be classed as one, and we get a nice rejection here off of this 50 EMA as well. So nice shooting star, whatever you want to call it, where prices move lower and lower and lower, and within the same hour, the bulls have come back into the market and pushed price higher, and prices then closed significantly higher than the low. So this shows that the bulls are in control, followed by an engulfing candle. which engulfs technically the previous 3 candles. So followed by this candle, it's a strong indication that price is going to move higher. So depending on your strategy, again, you can choose to trade these, or you can choose, I personally wouldn't, I'd be looking for an engulfing candle to engulf a bearish candle. But if this meets your criteria, we could trade this. And again, we get a winning trade. So price continues to move higher, and it would have hit our target on this wick to the upside here. So at that point, we'd be out of the trade. And then price comes back down, touches the 50 EMA. We don't get an engulfing candle. Again, we don't get an engulfing candle, and price moves lower. So at this point here, we're obviously not going to enter a trade. Not entering a trade. Price is broken above the 50 EMA. It's touched it again. Again, the 50 EMA is still above the 200. Price has touched it. We don't get any engulfing candles. Don't get any engulfing candle. Don't get any engulfing candle. This one, and then followed by an engulfing candle, and that does meet my criteria. So it engulfs a previous candle, which is a bearish candle. So again, we can place our 15 pips by 15 pips here. So we'd be risking 15 pips to make 15 pips. And again, you can see the moment we enter this trade, on the close of this engulfing candle, price moves higher, retraces back to our entry, and then moves higher and higher and higher, and hits our 15 pip target just here. Yeah, you could say, oh, what if I'd have stayed in and got on all this rally, but that's not part of your plan. Stick to your plan. You know it works, so don't worry about what you've missed or what you haven't taken advantage of. Stick to your plan. So we've risked 15 pips, made 15 pips again. So that's 3 out of 3. So we can move on to the next one. Again, the 50 EMA is still above the 200 EMA. So we're looking for buying opportunities. We're not looking for sales. Comes back down, touches it, get an bullish engulfing candle, and again, we get another winner. We enter on the close of this bullish engulfing candle, and price within the next hour, price moves straight to our target. So again, another winner. Follow it through again. Again, we've got a touch of the 50 EMA, but it closes below it and keeps moving down, so we're not going to buy there. Touch here, but we don't get an engulfing candle, so we're not buying. Touch here, we don't get an engulfing candle, so we're not buying. Touch here, we do get an engulfing candle. However, my rules, I would say this doesn't, we can see if it would have actually hit targets. I don't think it would have. Yeah, it would have hit targets. I personally wouldn't have traded this. Not that I trade this strategy anyway. But this candle closes not only as the wick, the entire length of the candle, so from the low to the wick, is completely below this 50 EMA. But the body, I would want the body to close back above the 50 EMA. So if this candle was taken into, let's just draw it. So I would want it to look something like that. So I would want this candle to open, obviously this candle closes here, so open at the close of this candle, and I'd want it to close back above the 50 EMA. The fact that the wick doesn't touch the 50 EMA as well, the entire range of this candle is below the 50 EMA. I don't like that. Whether you allow that or not, even if the wick was still touching, I might take it at that point. If the wick exceeded this 50 EMA and it engulfed below, then maybe. But I personally would like this engulfing candle to close back above the 50 EMA. Again, it's all subjective, it's all down to you at the end of the day, but you need to go this deep into defining your rules for entry, targets, whatever. You do need to go this deep and come up with very, very specific rules. Perhaps you say one of your rules could be, okay, this doesn't count, but if the next candle, like we have here, closes above the 50 EMA, then I'll get in on the next candle. But I personally wouldn't have traded this, so it would have hit targets, but let's just say we don't trade that. At that point, if you had traded it, you would have been knocked out of your trade here, so you would have missed this opportunity here. But seeing as we didn't trade it, we can get back in on this opportunity. So again, price comes back up, it touches the 50 EMA, Nice rejection candle here. We then get a bullish engulfing candle, which closes back above the 50 EMA. It completely engulfs this candle, and it basically completely engulfs the previous 5 or 6 candles. Again, stop loss 15 pips, target 15 pips. We're entering on the close of the candle here, and we hit that within a couple of hours. So that's another winning trade. Let's copy this across, move that one down. Again, we've pulled back down, we touched 50 MA but closed below it, so we're not looking for buying opportunities here, not looking. Again, broken back above it but moved below, so we're not looking for buying opportunities anymore. Right, now the 50 EMA is below the 200 EMA, we're now looking for sell opportunities. So we're no longer looking for buying opportunities, we're looking for selling opportunities, just in the exact reverse way. So here we get a touch, but we don't get an engulfing candle. This is a bullish engulfing candle, remember. We're looking for sell opportunities, so we want bearish engulfing candles. So another touch, we don't have that bearish engulfing candle. We would need this to close below our previous. We don't get that. Again, another touch here, but we don't get that engulfing candle. So although it would have been a winning trade, we don't get our entry reason, so we don't enter it. Again, here it's touched, but we don't get that engulfing candle. Here, broken above it, don't get an engulfing candle. And now our EMA is back above the 200. So we're looking for buying opportunities again. Again, no touch of the 50. We get a touch here, no engulfing candle, no engulfing candle. We do get an engulfing candle here, and it closes back above the 50, but we've had 3 candles close below this 50 beforehand. Again, being specific about your entry reasons, being very specific in your strategy. I personally wouldn't have traded this because there's 3 candles below it. Perhaps you can allow maybe 1 candle where it's fully closed below the 50 ME like we had before. Let me go back to that one wherever it was. This one here. So if we have, in this instance, we could allow a trade here because we've only got 1 candle closed below the 50 MA. Again, it's subjective. Like I said before, I wouldn't have traded it, but you could allow 1 candle to close below the 50 EMA, and then allow for an engulfing candle close above the 50 EMA to act as your entry reason. If you get more than 1, then you're not going to enter the trade. So going back to our current predicament, we've obviously got 3 candles closed below the 50 MA, so we don't like that. Therefore, even though we get this bullish engulfing candle and a close above the 50, we're not going to enter that trade because we've had more than 1. If we'd have had just this 1 candle, completely the entire range of the candle below, and then this bullish engulfing candle after it, then it's a different story. We would have entered, but we don't. We've got 3. So we don't like that trade, so we're not going to get in on that. Still above the 50, so we're not looking for sells, we're looking for buys. So we need it to touch it from the top rather than the bottom. We get a touch here and here. We got our first losing trade. So here we get a touch, we get another touch. Again, we haven't completely closed below. We get a bullish engulfing candle which closes above the 50 EMA, and price goes to our stop loss. So what's that? 1 out of 4. So at the moment we've got a 75% win rate. Yes, you can't base that off of 4 trades. You would need to go very far back into the future and get, I recommend, well over 100 trades to test for accurate results. But yeah, so our first losing trade here. So now the 50 EMA is below the 200. We're looking for selling opportunities. We get a touch here, but we don't get that follow up with the engulfing candle. Remember, we're looking for bearish engulfing candles now. Another touch here, we don't get that. We don't get it here. Again, we get an engulfing candle here, but we've had multiple candles close above the 50. Now we're looking for sells. We need them to be below. So not looking there. Not looking there. Again, this potentially you could have traded this one because there's 1 here, so that would have been a loser trade. This one, we have one candle. Actually, no, you wouldn't have traded it because it doesn't close below the 50. You would need it to be like this, completely engulfs but closes below the 50. Obviously, we've had loads of candles above this 50. This one, we only get one candle above 50. It completely engulfs but doesn't close below the 50 EMA. So we're not going to enter a trade in there. Again, still looking for buying opportunities. This one potentially here. No, again, we've got two candles. The complete range of the candles is above the 50 EMA. Depending on your strategy, you might trade this. But if you only allow one, then you obviously wouldn't. But this would have counted if you accept these two outside or above this 50 EMA. Then you get this bearish engulfing candle here. Completely engulfs the previous candle. Closes below the 50 EMA. So you'd be targeting now 15 pips profit target, 15 pips stop loss, and it would have hit your stop loss. But obviously we've got these two close above the 50, so we don't like that. And we're back above. Again, no trade here, no trading opportunity here. Back below here, so now we're looking for selling opportunities again. Nothing. Here, we've got another loser. So here we had a touch, no engulfing candle, pulls back up, get another touch, and this completely engulfs the previous candle. So we'd be looking at, this is reversed now, so we'd be looking at targeting 15 pips down here and a stop loss of 15 pips up here. This obviously reversed immediately, so it would have stopped us out here. Another one here, so we'd have been stopped out on that trade, then pull back below the 50, touch of the 50, an engulfing candle here to the downside, targeting 15, risking 15, and we would have got stopped out on this massive wick to the upside here before moving down lower. Again, this is just an unfortunate situation. It's a massive rejection candle, so it would have just spiked, stopped us out before moving and hitting our targets pretty much straight away. So that's just bad luck there, but it's just trading, it happens. So again, there's our entry reason. We'd have been in the trade up until this point, so there's no other opportunities there. And here, there's our next opportunity. Nice clean one. This is pretty much a textbook example of this strategy. So obviously in a downtrend, nice clean downtrend. Price moves back up, touches the 50 EMA. You can see all of these indecision candles where price is moving higher, it's moving lower, closing pretty much where it opened. Again, price moving higher, moving lower, price closes pretty much where it opened. Again and again and again. Finally get this big rejection to the upside. Big rejection back down. Again, none of these have closed above the 50, so this is all valid. And then we finally get that massive push to the downside. We engulf the previous four candles. And we're targeting 15 pips and risking 15 pips, and we hit our target. So this is, like I said, a textbook example. You can see it's moved up to the 50, price is unsure of the direction, and then we finally get our confirmation of the direction with this engulfing candle before price continues to the downside. And that's pretty much what we're after. That is exactly what we're after. Now I'm not going to go on and on and on. You get the idea. In terms of risk management, again, what you want to do, you want to take all of your trades that you've just back tested. So you're going to be doing this hundreds of times. You want hundreds of trades. Just go as far back into the past as you possibly can, and test this as much as possible. Test it, trade in with a candle close above, the complete range of the candle above, 2 candles above, whatever. Test it in different ways, see which ways work best, which ways are more profitable than others. It's going to take time. This isn't going to be an overnight thing. It's going to take a lot of time. But once you've cracked it, obviously it's a license to print money. So yeah, so once you've got this, obviously the next thing you need to do is determine how much you are going to risk per trade. I recommend as a beginner just risk either 0.5 or 1% of your account per trade. But once you've got all of these back testing results, you need to put them in a spreadsheet, compile them all, and then have a look at your risk management. You need to take into account drawdown, how many losers you're expecting to have in a row, all of these things, so that when you're live trading, you've got comparable things to compare it to. So if you're trading and your backtesting results said, okay, in my backtesting, I've tested hundreds of trades over however many years, I know I should only get a maximum of 5 losing trades in a row. If you're trading it live and you suddenly start getting 6 losing trades in a row, 7 losing trades in a row, you know something's gone wrong. More than likely is you've had 3 or 4 losing trades in a row, and then you've started making mistakes and you've started altering your strategy, and that's caused you to have more and more losing trades in a row. Again, then from there you need to work out your drawdown. So this might be in your backtesting, you figured out that, okay, if I risk 0.5% of my account, I'm going to see 5%, maximum 5% drawdown. So that's basically 10 losing trades in a row and you'll draw down 5%. So if you're risking 1% of the account and you have 10 losing trades in a row, that's going to be obviously a 10% drawdown. So you know, or over time, if you have 2 losers, 1 winner, 3 losers, 1 winner, and it equates to 10% drawdown maximum on your backtesting. Then you know if you have more than a 10% drawdown in your live trading, then you need to reevaluate your strategy. Have you taken everything into consideration? Are you taking into consideration the spreads? Because sometimes the spread will cause you to be stopped out sooner than you would have expected in your live trading compared to your back testing, so on and so forth. So there's these different things you need to take into consideration. And the main thing is getting a profitable strategy down, testing it, and then going ahead, trade it on the demo account, and see if there are things that you have missed out, certain aspects of the trading that you've not taken into consideration, like the spreads, like the risk, so on and so forth. So that's just creating the strategy from scratch again. Need to run through spreadsheets with regards to the drawdown and stuff like that. But I hope that has helped. Thanks for watching.